Welcome back to the Classic Business Investment Panel, brought to you by Liberty, and we're wrapping up our week-long focus on passives with a really fascinating discussion on what this trend will do to the market over the next 5 years. And listening to all of that, what then for the active manager? What is the role of the active manager over the next 5 years?
I think there's an awful lot of that's a really good question. There's a lot of skills that asset managers have that absolutely need to come into the equation. Somebody somewhere has got to start working on what is the appropriate asset allocation to achieve particular goals. You know, passive is not brainless. It's enormously complex, and it's enormously problematic to try to understand, you know, how do I meet a particular goal? What is the right combination of strategies? So intellectually, there's a lot of work that the asset management industry has that they can add to this debate if they don't, you know, if they're prepared to make that transition. But I think just to add to a point that came up earlier about robo-advisor versus financial advisor, we're talking about passive here. Financial advisors or robo-advisors can still, when they're using solutions-based strategies, use these things to great advantage. And if they're long-term things, I'm not really sure where the role of the active manager is.
It's very interesting because, as you know, looking at it from the outside, I would certainly see that the skills needed within this industry over the next few years will be, you know, not far removed from where they are now. You know, high capabilities in the hard sciences, maths in particular, and one would need almost some sort of coding background. Certainly, your quants are coming to the fore in this sort of environment in the core part of the game. To go back to that hated phrase, and Mike, as we were saying offline, perhaps that's where the active guys are going to be playing, is in that satellite space.
I think the active managers will have to add real value. So they'll have to add alpha. And very often in adding alpha, you've got to take on risk. So you can't just give the market the average return of the market, because the beta will give you that. The passive manager will give you that at a much lower cost than the active managers. The active managers are going to really have to find a role in giving out performance, and doing that possibly with more risk, but then educating the public that this is what we're doing. You can't go out and say, well, I'm an active manager and I've underperformed the market for the last 3 or 4 or 5 years because I've got a strategy which doesn't work in this current market, but may eventually work. The active manager's got to find a strategy that works in all sorts of markets. And I think at the moment, a lot of active managers don't have the solutions for all the markets. And the passive, as I think John was saying, there's so many passive products out now that they can actually put together multi-asset portfolio strategies which work particularly well in any sort of market, but at much lower cost and with much lower risk than the active managers doing at the moment.
Hannes, when I hear that, I also hear a deal, well, certainly on the very large end, we have pension funds that have investment committees, and they're probably a fay. If they're not a fay with this as an investment committee of a large pension fund, then you're probably lacking in your fiduciary responsibility to a large degree. But we have much smaller pension funds with general sort of trustees. Are these trustees of fay with these developments, and is that going to be the next area of focus in order to drive passives into the areas of that institutional money that perhaps are not quite as aware of all of these developments?
Michael, I think it's a great point. It's a very important focus area because Plessis represent the inline consumer. And if there's any change in the industry that will be well-lasting and productive, it really should be demanded by the inline consumer and their representatives. And so trustee education is critical. One of the interesting parts about the problem is that as we understand the risk structures more via indexing, we can more carefully calibrate different strategies to different objectives and so on. The onus of responsibility and the complexity of the decision-making is handed back down to the asset owner or the trustee representing the inline consumer and so on. So absolutely it's the case that much additional training is needed, much additional education is needed because those people representing the consumer will have to make much sharper decisions in future.
John, you're in that institutional arena, servicing many of the larger pension funds at the moment. How much of this forms part of your day-to-day conversation with trustees?
It's critical. It not only is it brought on by a lot of discussion from National Treasury. You've had the discussion Financial Services Board. I think it's PF 130 that specifically asks that trustees consider the merits of the passive investing universe. So really, as a trustee and as a consultant kind of working with trustees, you have to ask yourself, have we considered this? Have we considered the merits? And in any way, have we found them to be lacking? The critical thing for me, and to come back to it, is to say, are you paying the right people for the right results? Are you paying the price for alpha that is actually just beta? That's the critical thing. You don't want to be paying for the market at a price that is not necessary.
So therefore, we absolutely need to understand the difference between alpha and beta in various markets as well. And just as we wrap it up here, I heard you desperately trying to respond to Mike earlier when I just wanted to shift it around a little bit. Let's come back to that.
Well, I mean, he was making a comment about all they have to do is just get that alpha, and I thought, yeah, in every market environment, and I said that's not going to happen because that simply can't happen. But there's one way to really get the active managers back into the equation here, and that's to get them to lower their fees. You know, I mean, they're the ones that jack the fees up to absolutely absurd heights on the strength of this ridiculously long bull market we've been in. So they've looked at that and said, well, look, we've had this enormous bull market. Of course I'm adding, all this value to you, so here's your fee. So if we can get back to the kinds of fees that we had back in, all right, when was it?
I don't think anyone can remember back when we weren't in a bull market. But what about just a different fee structure altogether, where we share some of the downside and we say, listen, we're willing to share in the upside with you, but we're also going to say, we'll share on the downside as well, and thereby aligning investment goals and outcomes.
No, because that doesn't work, because you cannot, in this market, get the appropriate benchmark for that. So what you're typically doing is that your outperformance may have very little to do with manager skill, as what might be your underperformance, simply because the benchmark is an inappropriate bogey for that, maybe a measurement for that manager. So it's almost impossible to do that. That sounds ideal, that sounds wonderful, but it's almost impossible to get the right benchmark to make that reasonable.
Well, unfortunately, we've come to the end of our time at the end of this investment week, and I found it thoroughly enjoyable, and I think I'm going to put a request in for an hour next time round so we can tease out a whole lot more. When we look at the next generation of smart beta, it looks like there's a whole lot coming down that pipeline as well. But I think the big take home for me certainly was that passives have evolved so much over the past 2 decades, it would seem, to a point where, as we've been saying, they serve most of the primary functions of portfolio management, core investing, opportunistic investing, risk management. We can go on. And it really is a question of fees, and a question that the industry is going to have to answer, or it'll find itself disrupted in the same way that many other industries that have been quite comfortable and ensconced in that comfort have been disrupted. I'm thinking of Uber and how it's disrupted those exorbitant metered taxis. But we also heard tonight that the cycle of the market is important, and we are facing a period of muted return. So that might play into the next 5 years as well. Thanks to all my guests this week, and in particular tonight, John Taylor, Investment Servicing Manager at Liberty Corporate, Anne Cabot-Alethauser, Head of Alex Forbes Research Institute, and a serial contrarian. And thank you so much, Mike Brown, MD of ETFSA.COSA, and Hannes du Plessis, part of Citadel Asset Management, which manages the investment solutions for the Citadel Group. And remember, if you want to add any of these discussions to your investment audio library, then you can download the audio files directly from the Classic FM website, or you can get them from my producer, Jono Adams. From me, Michael, and sound engineer, Mdutele, thanks for tuning in to this investment panel discussion, which has been proudly brought to you by Liberty. Good night.
Hi, I'm